of advice do you have to homeowners?
Practicing that preparedness. Starting the conversation now is always going to be a benefit to any association out there. And welcome to Recovery Report Live. I'm Dan Odess, President of GlobalPro, where we manage your risk to recovery, and we have managed more than $1 billion in damages. We want to inform you weekly about things you can do as a policyholder to protect your interests, whether it's placing insurance or recover from loss. This is your source for insurance news, business news that you can use and implement, whether you're a community association manager or a business owner or a high net worth individual. This is the information you can use to help protect your interests. I'm very excited about today's broadcast because it marks a huge milestone here for GlobalPro and the Recovery Report Live show. It is a 40th episode. Also, it happens to be the week of my 40th birthday, so it's a little bit extra special for me. And I'm super excited about our guest today, and I'm not going to spend a whole lot of time talking to you directly. I'm going to bring on our guest to talk about important news that's going on that certainly impacts us as business owners, community associations, and high net worth individuals. We're going to talk about all the things that you need to know regarding the legislation session here in Florida and some case law that's out there as it relates to some of these pandemic claims that we're still dealing with. We're not out of the woods. Things seem to be moving in the direction of the policyholder. There's obviously some adverse decisions, but again, we're going to continue updating those things as they evolve. I'm excited to be here with you today. Obviously, it's our 40th episode, and also in a couple weeks it's going to mark the countdown to our 10th anniversary at GlobalPro of helping policyholders like you navigate the claims process, help you place insurance, and make sure that you're getting the most out of your business and your community day in and day out. So stick with us, keep tuning in. We're going to be counting it down here at the end of March. I'm very excited about all the things that we have planned this year. We have so many things coming up, whether it's the hurricane season preparedness to additional community educational classes that we're going to be teaching. We have a lot in the hopper that you haven't even seen. I'm excited about the Claims Advocate. The print material is going to be coming out. It's going to get delivered to hundreds of community association managers. They're going to actually be able to enjoy all this information right there in print, share it with board members, other managers. Again, we want to be your source for insurance and business news that you can use, and we want to make sure that we continue to give it to you in many different forms, whether it's that you have an opportunity in front of your computer to tune in live with us here, or it's to grab our magazine, The Claims Advocate, and read all about all the important information that impacts you as a policyholder. So keep tuning in. We're here. If you haven't yet, hit that subscribe button because we want to make sure that you get all the updates about our show and all the things that we're doing. So again, let's get rolling. I want to bring on our next guest right away. I don't even want to wait for later in the broadcast or talk anything more about this. Craig Applebaum is here with us today, our Senior Vice President, to talk about legislation updates, things that are going to impact us here in the Florida market, as well as some case law out of California that is certainly important. But before we get there, we never really had an opportunity to meet some of our team. We talked to them on occasion, and Craig has even enjoyed us on prior broadcasts, but I'd like you to meet our team, get to know them a little bit. So I'm gonna kick off some questions, almost like a job interview, Craig. I hope you're ready for this. And I wanna first talk about your background. Craig, where did you grow up? Talk to us a little about your family life and really what shaped you today, or what has helped you become the person you are today?
Sure. First of all, I want to say I am very excited to be here for this 40th episode. Before your 40th birthday, what an honor to be back here for my second time now. But a little about me. I grew up in Boca Raton, Florida. I went to high school in Lauderdale, college at the Florida State University, and then law school at University of Miami.
Fellow and all.
Yes. Yeah. And when it comes to recruiting, whoever reports ethnic Florida State, it's a global situation over here.
Yes.
And then after that, I went to complex business litigation and litigated for a number of years, and then ended up at GlobalPro. And it's been great. I think we're between 4 and 5 right now.
Yeah. So, well, tell us a little bit about you outside of work. Any hobbies? Any special interests?
My post-COVID hobbies include watching movies on every single media platform, Apple TV, Netflix. But before that, I really did enjoy playing basketball, swimming, really outdoors. I'm picking up biking now. Inspired a little bit by yourself, who I know is an cyclist.
Yes.
So,
definitely enjoy a good bike ride when I can get out there and do it. And unfortunately with the pandemic, it's been far and few opportunities to probably get in a gym and shoot some hoops, I'm sure. And I know you can't wait to get back to that. Let's talk about a little bit your career though. When you were litigating, the types of cases you were handling and the successes that you had there.
Sure. So did a number of class action cases, was counsel on county malpractice cases, and some catastrophic personal injury as well. And just was very successful, was able to write briefs for the state appellate courts as well as the federal appellate courts, as well as help try cases, state and federal. So lots of great experience writing.
So here at GlobalPro, we have a heavy focus on goals. In fact, I've done some business strategy session videos and we've posting about it. Craig, you obviously participated in our sessions here. One goal for 2021 that you hope to accomplish.
One goal for 2021 that I hope to accomplish. That is a good one. For me, I really want to see the goal of celebrating the wins with our client.
Yes.
I think that in the time of COVID, it's become really hard for us to do that. Something that we used to do well, and as a result, finding a way to do that in a socially distanced world is something that's really important for me, because for so many of these clients, associations, businesses who are refused coverage, and then to be able to get them substantial coverage and payments to help restore them, and in some instances, keeping their businesses alive, is huge. It's something that absolutely should be celebrated. And doing that with them, I'm looking forward to either finding a way to do that or having them vaccinated so that we can come to it together with that.
Well, I couldn't agree with you more. Hosting dinners and celebrations and just seeing everyone in one place again, to teach classes and to engage them on another level. Definitely a big goal here. It is definitely something that I share with you as one of my top goals for 2021. I really hope that we have that opportunity to do that again in person. Obviously, we continue to try to do things, whether that's through Zoom or virtual or socially distanced, but it sure would be nice to get everyone back into a space to celebrate. And it's not only just celebrating, getting that recovery, it's the path forward and the rebuilding that can finally start. So we're very excited about that. And especially since I know we've had a slew of claims that received denials over the last 6 months that have been converted into recoveries by our team, particularly you and Josh. And I'm very excited about all those things. And those are big celebrations, because where an insurance company got it dead wrong, we were able to overcome the odds and actually get them a recovery. And that is certainly something that we should be celebrating more and more with our clients. And I can't wait to get to that. So speaking of things that insurance companies get wrong, it's a good segue into into some of the direct questions I want to talk about, and some of the things that our viewers need to know about some of these proposed bills in Florida and their implications for community associations, and some of the things that you as property managers or board members should be thinking about, because these are proposed bills. Now, these are not laws yet, and may not ever become laws, but they do come with a lot of support. So while it may not be the final version of it, we want to talk about the issues just so that you're aware of it, because it's probably something that you don't get a lot of updates on. And we think it'd be prudent for you to know about some of these things. So we got two bills that we want to hit on, which is two Senate bills, 1598 and 76. And we'll make sure that there's links available to you guys in our email blast as well as on the website for these bills so you can see them and track them along with us. So Craig, talk to us first a little bit about Senate Bill 1598. It's titled as a consumer protection and companion bill to House Bill 717. That's a mouthful, so we want to make sure that you understand what that is. Consumer protections, but there is or isn't some of the language in there that's actually, and we're going to talk obviously, oh yeah, by the way, disclaimer though, this is not on the entirety of the Senate bill. A lot of times, just so you all know, is that you have a bill and then you have a lot of tag-alongs and issues that go along with it. So we want to make sure that you're aware that there may be things in this bill that are totally unrelated to property. We're going to focus on the property insurance issues. So Craig, take us through it a little bit.
Sure. So as it concerns public adjusting and what the associations and businesses insurance should know about it is that public adjusters are going to be required to produce an estimate within 60 days of the loss, which is nice for the claim in terms of helping provide some sort of guidance and a path for insurers in terms of when they can expect certain milestones to occur. I know that it's very common when we're doing our claims that the clients want to know, hey, when's your estimate going to get done? When's the insurance company's going to get done? Obviously, the biggest question, when are we going to get paid? So that helps move that along. And to address that big question of, hey, when do we get paid? This bill also puts surplus lines on the same footing as admitted carriers insofar as they have 90 days to deny or pay the claim.
Which up into this point, only admitted insurers, let's say citizens and the like, had to comply with that. So that's the difference between a surplus lines and an admitted insurer. Those surplus lines, those are not here locally, right? So.
Yeah, and also something that I don't think most of our insurers think about or probably through their policies to see, but what we've been seeing a little bit more frequently is foreign venues when it comes to litigation. So you can be entered into a policy in Florida, but have a venue provision, put you in New York or California. This bill proposes to stop that and actually prohibit foreign venues in the event of litigation.
And so why would that be important to a community association?
It's important for a number of reasons. For one, to have to fight litigation in a place other than where you're located can be quite difficult. It can be quite difficult in terms of expenses. It can get very costly, especially when it comes to discovery. If you have to make appearances in that court, having to fly across the country, let's say, to court in California, or to do discovery in California, it's very costly, very quick.
And also, too, some of these states don't even have the same consumer protections that we have here in Florida. So you're adjusting a claim in Florida, it's supposed to pay in Florida, but somehow I'm subjected to, let's say, New York, California law suddenly. I got to imagine that would be a very confusing situation. And also, I saw one instance where they actually had to retain local counsel on top of the counsel they had here locally in Florida. So you're just compounding issues. I want to go back to the 60-day requirement thing too regarding the estimates. We frequently see insurance companies not even produce their own evaluations in 60 days. So I agree with you that I think it will help, answer that questions from the time that you sign a contract with a public adjuster to the time that they have to give you an estimate. If you were to hire a public adjuster, let's say after the fact, after your insurance company denied your claim or after they lowball paid you, I see this a bit of a conflict or a difficult situation though if you hire the public adjuster at the onset of a loss, given the fact that the insurance company has 90 days to coverage determination, and sometimes they don't even comply within 90 days of doing that. But I am a proponent of the 60 days. I want to make that clear. But I do say that, it's a little bit of an interesting burden that they're putting on, let's say, the insured's representative as opposed to the insurance company's representative. the independent adjusters. So what are your thoughts on that?
I think that it is good overall. I think that the spirit of it I agree with. However, in enforcement or practicality, it gets hard. And I think about, for instance, a hurricane claim and how long when the industry is inundated and everyone's got hundreds. Some of these insurance companies have thousands of claims.
Yep.
And to expect them to get an estimate done within 2 months or 3 months, I mean, you just don't see that very often. I would love to see it. I would love to see the times on claims get reduced, because honestly, one of the problems in the industry recently has been they're slowly but surely going back to the practice of delay. And you're seeing the process go from a 3 or 4 month process to 6 to 8 months for no reason other than the fact that really the insurance companies just aren't getting around to it. But from the adjuster's side, I love it. I think 60 days to get the claim moving, and again, to have that certainty for an insured is great. I just worry a little bit about the practicality of it when there are only so many people to write estimates for all these things.
Yeah, and I think from our perspective too, and for community association managers or property owners that are tuned in today, think about when you do hire a public adjuster, their resources, their capabilities of doing it. I have no doubt that GlobalPro can comply with these terms, certainly that be proposed. But I worry about other public adjusters and other experts out there and their abilities to do it, and why they may feel a desire to take on a lot more work than they can actually manage, and what this can mean for them. We certainly are positioned with the right amount of resources to be able to respond to do these things, and we track those things with proprietary software, making sure that our resources are allocated properly and doing those things. But I think it definitely is going to complicate for some of the other experts and public adjusters out there. So definitely something you want to keep track of. And as you're interviewing potential public adjusters, making sure they have the resources to comply with these new terms and obligations if it does become law, definitely something important. But there's one last thing in this bill too. I want to, before we move on to the next one, which is Senate Bill 76, the bill also contains some language in it requiring insurer to pay policyholder interest for unpaid claims immediately rather than having to seek remedy in the courts. I mean, Craig, how big is this for policyholders?
I love it, again, especially where you have so many insurance companies taking their time, as I was just referring to, as one of the problems in the industry is that you're seeing claims go maybe 25 to 35% longer than they used to, and not for any reason, not because the claim is super complicated or anything. It's just because the insurance company isn't putting the money into going ahead, finding out what the cause of losses, getting their estimates out. And as a result, who gets hurt? Not the insurance company. The insurance company gets to hold on to their money. We just had a claim, as you know, a multi-million-dollar claim that took a while to get done, and they should get interest on that. And they should have got interest on that, because there was no reason why the insurance company should have waited as long as they did. I mean, they failed to produce an estimate for a long time. And when that happens, it's the absolute detriment of the insurer, especially if you find out later on that your claim is covered or they accept coverage. They should have done that months ago. So why not get the insurance?
Yeah, I mean, they're not a bank, right? They're holding your money that you could otherwise be using to rebuild. And we talk about the signature process, ready, recover, rebuild, right? So in that recovery phase, when I'm getting that money, I mean, they have prejudiced me from benefiting from my benefits that are afforded to me in the policy. So, it doesn't make sense.
And especially where insurance companies end up paying these claims, but a year later, for no reason other than they just didn't get around to paying you, or they didn't want to. I know a lot of times you hear these horrible stories of homeowners where they put in their claims and like years later they get paid. They were never even denied. The insurance company just took forever to send someone out there. So as a result, though, as you said, they lose the benefit of having that money or having the property restored for a year, their homes restored for a year. They should certainly be able to get the interest on that money that they should have been given months or years ago.
Yeah, I think it's accountability, holding responsible. I'm all for that. That's what we do here in representing our clients. We want to hold the insurance company responsible. We want to make sure that our clients are complying with their own obligations. And if they are, and if they have, there's no reason why they should happen. So let's move on to Senate Bill 76. It's titled a residential property insurance, and it's part of a companion bill to House Bill 305. We're in Miami. That's a little relevance there. But so talk to me a little about Senate Bill 76. What's it about?
Okay, so the big implication for policyholders is that it's going to codify into statute the ability for the insurers to offer ACV coverage for roofs based on a schedule referring to the material and age of the roof. That is a scary thing for an insurer, because you're being told what the value of your roof is, not by based on a market, but by however the insurance company decides to value your roof.
Yeah. So I kind of feel like the first bill was, let's hold everyone accountable and responsible, and then the second bill is, let's pay them less money. So, and take rights away from the policyholder. Definitely very, it feels like two very different bills. On one side, we hold people accountable, whether that's public adjusters or the insurance companies, and we're going to make them pay if they don't pay you. And then now we have another bill that comes in here that says, okay, by the way, you're going to continue paying historically high rates, the highest in the country. They keep going up and everything else, but we're going to figure out a way and devise a way to pay you less. And I struggle to understand how this in any way helps communities recover from large disaster. I mean, what does it mean to schedule the value of your roof? And talk to us a little bit about ACV, Craig. What does ACV mean?
So ACV means that the depreciation is going to be taken out for the loss.
Right.
So you're not going to be. It might cost you $100,000 to replace your roof, but based on whatever mental gymnastics the insurance company comes up with, 10-year roof, maybe they'll say $60,000 will give you, and that's what your roof is worth now. And you have $40,000 depreciation, and then that's up to you to figure out how you're going to come up with this other $40,000 for your roof.
Yeah, and if you think there's
probably they're going to drop you if you don't do it.
And if you think there's some type of really reason for the $40,000 deduction, Craig's example, think again. Look in your policy for the terms and conditions about actual cash value. Understand what ACV, which is actual cash value, or RCV, which is replacement cost value, mean, and then find me a definition for depreciation, and find me in that policy where it tells you how they're supposed to take it. I mean, frequently we see insurance companies, independent adjusters, those that represent the interest of the insurance company, the people that come out on behalf of the insurance company, they don't represent your interests as a policyholder. We see them randomly apply depreciation, which Craig has been talking about, to an entirety of a line item, meaning they're depreciating not only the value of the material, which is it should only be applied to, but also the labor, which honestly makes absolutely no sense. How is my labor worth less? All right, it doesn't actually make sense. Having studied industrial engineering and materials and having to run huge depreciation schedules, I can tell you right now, that does not make sense. We talk about efficiencies in labor, we talk about depreciation in material and tooling. It's certainly not something that should be broadly applied. So look at that stuff. When the insurance company starts talking about withholding money in your claims today, make sure that you're looking at the stuff, fighting back, looking at those issues, drilling down on it. Don't let them hold your money. It does not make sense. That's an unpaid portion of your claim, and it's no reason why they should hold back on that stuff. And as it relates to any other provisions of your policy, make sure you look for definitions of these things. I think it's really important. And if this does become law, are they going to write it into your policy, tell you what that schedule is? Is your broker going to educate you those things? We can be that source of information. I highly doubt it's going to appear in your policy. I highly doubt most of the brokers are going to pay much attention to it. We talked about contractor issues, and I think that a lot of these bills go to those, speaking to those issues. And unfortunately, like a lot of the laws in the past legislation session, restricted the policyholder's rights more so than the contractor rights. And it's a bit of a trend when we see with a lot of laws and legislation. So, and most of the brokers don't even are aware of it. And a lot of you managers out there probably, or may have one time taken a class from a contractor on insurance. The irony is that contractors aren't even allowed to adjust a claim, but somehow they're teaching you a class on insurance and telling you what you can or can't recover for. But the reality is they're not even allowed to get involved in that process. And I think some of the things here in the prior bill are definitely some of that will help clarify that things. Anything else you want to add to that, Craig, before we move on to some case law?
Yeah. Two things. One, you also want to check for what insurance company is depreciating. Because I've seen them try and depreciate laborers, where they said you had 5 laborers that they were going to pay for, and then because they depreciated the entire estimate, not bothering to actually look at what they were depreciating, they end up saying you needed 3.5 laborers. Yeah, which makes no sense. And when I brought them up to it, they changed it, but again, that's for the insurance out there, you want to be paying attention. The other big thing in this bill is the first notice of claims.
Oh yeah, yeah.
From 3 years to 2 years is huge. Right now, you have a statute of limitations on hurricane claims at 3 years in terms of notice. They're trying to say now 2 years. Is what they're trying to push through in the bill. I think that's not in line with what the case law is. 3 years, they came to that because a line of cases found around 3 years, and in excess of 3 years for these hurricane claims, they were getting dismissed for violating the notice statute. I have rarely seen the case where or non-hurricane claim under 3 years getting dismissed on notice. I don't actually believe I've seen one. I'm not saying it's not out there, but it would certainly be the exception, not the rule, in terms of the notice and loss. So I think that's a huge piece of additional legislation being wrapped into this bill that could pose major negative implications for insurance.
Yeah, so it seems like they're just trying to cut out more opportunity, right? So we have actual statistics, real stuff, which Craig is talking about 3 years, and now they're trying to take another year away from your ability to make notice of that things. And if you've never experienced a hurricane claim, then you won't understand that it does take time to realize at sometimes it does take time to notice these claims, these damages, things happen, availability of material, the availability of labor, things take time. I mean, within that first year, most people haven't even really started rebuilding. It's not until year 2, if not year 3, where we really start going, especially for community associations who have to reserve for these things when they have multi-million-dollar deductibles. They have to raise that capital or that money in order to be able to actually really do the substantial repairs. So you might not even know what it's actually going to cost you. And with the rising cost of construction year over year, what you thought may have cost you $1 million today in 3 years could cost you $2 million, but it took you, let's say, into the next year to have the meetings on, to get the votes, to raise the money, and then you get the planning phases, you get the permits, and next thing you know, you're at the end of year 2, going into year 3, and now it's costing you $500,000, million or more dollars to do it. And so it's really important to be able to make sure that you protect your interests and do these things, and some real life issues there. So let's talk some case law though. So first case up is State Farm versus Sanders, a Florida case. Bit of an update on it. Obviously, we don't have the holding in this case yet. But before we get into it, I went a little background on it. Talked a little bit about this idea of appraisal. We've mentioned it in a prior recovery report, posts, whether it's on social media or I've talked about some strategy for policyholders. Generally speaking, appraisal. Craig, talk us through this dispute resolution method that helps policyholders shorten the length of time it takes to actually get paid to determine the amount of their loss.
Sure. So appraisal, the process is found in almost every policy, I believe, where you have an appraisal provision. Some of them going in and instead defer to other ADRs, alternative dispute resolutions, such as arbitration. But most do have appraisal. The appraisal process is meant to help move the process along where you have two independent experts, more or less appraisers, go ahead and appraise the value of the damage to the property. And then they're trying to work together to come to an agreement on what the total value of those damages are with the help of an umpire.
So we have an appraiser for the policyholder, appraiser for the insurance company. They pick an umpire. The two appraisers try to work it out after they've set the amount of loss separately. If they can't, they go to the umpire, an award gets issued. Based on policy provisions, the insurance company then has an obligation to make a payment within a certain amount of time period. And there's this issue in this case regarding who can actually be your appraiser. So what seems to be the point of contention, though, in this case?
So the point of contention is that the policy provision requires that the appraiser be disinterested. And the case law has been changing throughout the state and more or less refers back to the AAA, which is arbitration rules, and stating that if you have a financial interest in this, especially as it pertains to adjusters in a contingency fee arrangement, you are not disinterested, and therefore you would not be able to serve as a disinterested appraiser.
And I think here at GlobalPro, we're a bit on the fence whether we support or against this. And in most instances, what I think is actually most important, more so than even disinterested, is actually qualifications, and making sure that the person representing you in appraisal actually has some semblance of competency that is more so than just, oh, I was an IA for 20, 30 years, and then I became a public adjuster. Making sure that you understand the implications of certain case law or construction practices and engineering. Make sure that your appraiser that you do select is competent, and that's typically what it says in the provision. It says disinterested and competent. I struggle to think that a former independent adjuster or even someone that's a career public adjuster is competent enough to act as an appraiser and to set that amount of the loss. In fact, that's why we at GlobalPro have a team of experts that are mostly licensed in something other than public adjusting, because I believe the insurance process becomes complicated and requires this certain expertise. These aren't the days of easy policy forms and insurance companies that are just not paying you. This is complicated policy forms that are continuing to become more and more complicated by either case law, legislation, and as well as language that we're seeing up here and there. So you need to understand the different elements and aspects, and I truly believe you need a higher level of competency in order to act as that person. So there's a lot of people out there that are lobbying for these efforts because they are career public adjusters or career adjusters that have absolutely no experience in construction, or whether it's law or architecture or engineering, some sort of level of competency to be able to navigate those things. And I say that not only as you're vetting your public adjuster to hire them, but I say the same thing as you're vetting and hiring an appraiser to act in your interest. Make sure you understand it. This isn't just a simple matter of, oh my God, I've been doing this for 30, 40 years and I know what the insurance company will pay for or not pay for. That's not how you should judge the competency. Just because I know insurance is going to pay for, just because they won't pay for something doesn't mean it's not covered nor you're entitled to it. So I think that's a bit of a struggle for some people that just kind of get into a groove, and next thing you know, you're leaving money on the table because they'd rather avoid the fight or avoid the issue because they can just simply just kind of move past it and get you a number. We don't want to do that here at GlobalPro, and I think it's more important to look at the competency more so than how someone's being compensated. And I'm understanding, Craig, there's a little bit of body of case law out there about contingency fees anyways, and that seems to be the issue for public adjusters, that because we're getting paid on a contingency fee basis, they don't want us to act as the appraiser on the same case, right?
Yeah, that's exactly what it is. It's that the courts find that that's enough to disqualify you from being a disinterested appraiser.
Yeah, so we're getting a little long here. I want to make sure that we get this last case in here. This is for our business owner clients out there because there is a bit of an update. We got this case, Craig, on it's a pandemic related issues. Obviously, we've been continuing to update you guys on that stuff. Whenever it comes up, you'll hear it here first. King Gray versus Farmers Group Inc. Talk to us a little bit about that.
Sure. It's a case concerning class action, which had to do with a few different plaintiffs, some with virus exclusion, some without a virus exclusion. The court found that direct physical loss did in fact mean something different than direct physical damage. Also said that if they didn't, it would just make the language superfluous and thus meaningless. And so that dispossession of the property would qualify as a loss, at least on the motion to dismiss stage. This is important because this is now the third opinion recently, one in the Northern District of Ohio, one in the Northern District of Illinois, now the Central District of California, looking at New York and California law, saying that the disposition, and whether that's by governmental orders, you want to say it's from the virus, but losing possession of your property, not being able to open it, having to make material changes to it, would all fall or could potentially qualify as direct physical loss and therefore deny insurers motion to dismiss. The other part of this is that if you do have a virus exclusion, the court here excluded the coverage for the policy and denied with prejudice those plaintiffs that had a virus exclusion.
All right, so important case to track. Obviously, we want to continue to update you guys. Hey, Craig, awesome to have you on. It's 40th episode, 40 years of being on this earth, my man, and I am happy to share the stage with you today. I want to, very much appreciate it. I know that our viewers, our listeners, our clients can all use this information. So again, thanks for coming on today, taking the time this morning to provide some really valuable insights. Do it again?
Anytime. It's great to be here. Again, such an honor to be here for the 40th, the week of your 40th. So just a great experience.
All right. Well, Craig, thank you all. Thank you for everyone that's tuned in this week on our Recovery Report Live 40th episode. Again, I'm very excited to start the countdown to 10 years of GlobalPro, helping policyholders get everything they're entitled to, making sure they're protecting their rights, getting the policy, getting the recovery, making sure they're navigating that difficult claims process that continues to be complicated by whether it's legislation, policy changes, practice issues of whether it's insurance companies or construction, whatever it may be. We are tracking those trends for you. We're making sure that you're getting everything that you're entitled to, whether it's from buying the insurance to recovering from a loss and rebuilding, right? It's that signature process, ready, recover, rebuild. And I want to remind all of you that if you do have a loss or you need information about insurance, whether it's placing it for your home, your business, or community association, call us first. We are your source for information that you can use to make sure that you are protecting your interest. So don't hesitate, hit the subscribe button, check us out on social media, like us, follow us. We are here to help you. We are going to continue to put out information for you. Our team is one call away, one email, text message, DM us, whatever it takes. We want to be your source for insurance news you can use. We'll see you next week on the Recovery Report Live.